All right, why don't we go ahead and get started? Thank you for attending our Next Level Planning Group monthly webinar session. We are already in November, which is hard to believe. So we have November and December left. We have had a wonderful round of various speakers and topics throughout the year. If anyone is ever interested in seeing the list or seeing any of the videos of the recordings that we've done in these webinars so far, please don't hesitate to reach out to myself or Will Thorman or your financial planner on our team. I'm very excited to introduce our speaker today. Adam Stock is going to be talking on year-end tax planning and potential tax changes. So this should be, as we put in the invitation, a scintillating presentation today by Adam. And I am very excited. Adam is the founder of the Next Level Planning Group. Adam, I just did the math today. We've known each other for 13 years. Adam and I go way back. He was a mentor and a business coach of mine back in the day. And I joined the Next Level Planning Group back in 2008 under his leadership. So for over 2 decades, a little bit more about Adam. For over 2 decades, he has been helping clients navigate the many challenges in the present so that they can experience a more meaningful and joyful financial future. He survived 4 winters in Minnesota and graduated from Carleton College cum laude. Adam also performed additional coursework at the London School of Economics. Dedicated to honing the craft of financial planning, Adam has obtained his CFP and also has the exclusive Master's of Science degree in financial planning. He is currently in the process of becoming a chartered advisor in philanthropy. On a personal note, he and his wife, Melinda, have been married for 20 years. Their courtship began with Adam tutoring Melinda in calculus, and they didn't multiply, though, until much later, and now have 5 children, ages 15, 12, 9, 6, and 3. And when he's not working and spending time with his family, you can certainly find him sleeping. And when he's able to muster additional energy, you can find him playing basketball, violin, and volunteering at a synagogue where he has served as the member of the board of trustees. He currently serves on the foundation board, and he plays violin at the soup kitchen. So without further ado, Adam, I'll turn it over to you.
Thank you, Cassie. Can you hear me okay? All right.
Great.
All right. Welcome, everybody. I'm delighted to be here and nerd out with you on taxes. It's one of my many joys. I know some people think that's a little bit odd, and that's fair. I'm going to share my screen here and we'll get going. All right. And can you see my screen? Yes? Thumbs up? Good. Okay, great. Yeah, so we're going to talk about year-end tax tips and what's new in 2022. And I'm going to start with the what's new in 2022 for sure. I'll talk a little bit later about what might be coming in 2022. I'm going to start with the good news, because maybe some of the news you're not going to find so good later on. So I'm going to start with the good news. And the good news is that those who are receiving Social Security, either you, parents, grandparents, are getting a big raise in 2022, 5.9% cost of living adjustment, the largest in over 30 years. So those of you who have been taking Social Security, you've seen 0% increases for 2010 and 2011. You've seen 1.2s, 2.3s, big 5.9% cost of living adjustment coming your way in 2022. All right. Some other updates. So the 401k and 403b maximums contribution limits are increasing from $19,500 to $20,500, extra $1,000 towards retirement. For those of you that have a SEP, a simplified employee pension, that maximum is going up $3,000 from 58 to 61. Flexible spending account is increasing slightly. Health savings account is increasing slightly as well. So the rest of the changes that I'm going to talk about relate to income tax, retirement contributions, and estate tax. And let's talk about income tax. First, some tips. I'll give a case study here. Case study, Rob and Roberta retiree who are 73 years old. Back in 2000, at the end of 2017, with the Tax Cuts and Jobs Act, the standard deduction doubled. So if you'll recall, we can either take a standard deduction or itemized deductions, whichever is greater. And the three main itemized deductions that go on Schedule A are your real estate taxes, your mortgage interest, and your charitable donations. There are some others, but those are the three big ones. So this is an example of Rob and Roberta. Their standard deduction, because they are over 65 years old, is an extra, they get an extra $3,400 on the standard deduction. So it's very high. On this example, $28,500 would be their 2021 standard deduction. And so let's just pretend that Rob and Roberta have $15,000 of real estate taxes. They've paid off their mortgage, so they don't have any mortgage interest. And oh, by the way, there's the SALT tax limitation over you'll recall. So we're only able to deduct a maximum of $10,000 of real estate taxes. So what you can see here is that there's a gap, and there's a gap between this $10,000 over here and the $28,500 over here. Well, so what's the implication? The implication is that the first $18,500 of money that they give to charity, they're not going to get any tax benefit for that because they would end up taking the standard deduction. So they're still getting benefit from that. The charity is going to get benefit from that, but they won't be able to deduct really any of those donations. So what they can do is they can use their required minimum distributions from their IRAs to make direct charitable contributions. This is called a QCD, a qualified charitable distribution. Now you can only take this if you're over 70 and a half. So even though they changed the rules to 72 for taking required minimum distributions, you're able to use this strategy if you're over 70 and a half. But it works really well if you're forced to take distributions, that you use some of those distributions to go directly to charity, because then in effect you're able to use that deduction in a way that you weren't otherwise able to do that. Okay, well, what about all of us who are under that 70 and a half year old age? What is it there for us? So let's take Paul and Paula Professional, 62 years old. And so they have a standard deduction in 2021 of $25,100. And let's just say that they have some real estate tax, they have some mortgage interest, and that totals $22,000. So you can see that for the first $3,000 roughly, there's a gap. For the first $3,000 that they would give to charity, they would not get any deduction for that. So what Paul and Paula can do is they can do what's called bunching. And basically what they would do is 1 year they would give $6,000 so that they would get they'd be able to itemize in 2021. And then the next year they wouldn't give any, and they would take the standard deduction. And then the year after that, they would take the $6,000 again. And so they're just going back and forth. And this is a way to get roughly $3,000 a year to charity, but to get more deduction, more tax deduction, because you're itemizing in alternate years. Another strategy that they can use is what's called a donor advised fund. And we did a study just looking the other day, and one out of roughly every 4 of our clients has one of these set in place. So we're very high on the donor advised funds. And basically what the donor advised fund allows you to do is put a large chunk of money into a fund and get the full deduction in that year. So for example, if you might give $5,000 a year to charity, you would put $25,000 in 1 year, and then you wouldn't have to do the bunching because you would just take the itemized deduction in that year that you make the large contribution, and then you're able to siphon out from that donor advised fund any amount of money over the successive years. So this is a really nice strategy when people are about to retire as well, and they're in a high tax bracket, and then after they retire, they're going to maybe be in a lower tax bracket. This is a way for them to fund one of these donor advised funds and get a large deduction in a year that they might be in a high tax bracket. So the donor advised fund is another option. Now that I've told you all this, I do want to give you a hot off the presses breaking news. This was recently released that even for those who do the standard deduction, there's a little bit of break. So you didn't have to do the donor advised fund or the bunching. There's a small allowance so that if you're single, the IRS will count the first $300 of charitable contributions. If you're a married couple, they'll count the first $600, even if you take the standard deduction. So now we're going to move on to what's going on in Washington with the Build Back Better bill. Lots of B's there. I think Build Back Better seems like a good slogan for a chiropractic agency, but in this case, it's not building a better back. It's about building back better America. With a quick caveat here, and that is that the first commandment is thou shalt not shoot the messenger. So I'm just the messenger, and I'm not making these rules up. So I'm going to describe for you what's currently being considered right now. This is a very dynamic, quickly changing situation. So nothing is currently set in stone like the stone tablet you see here, but it's definitely something that over the next few weeks you want to pay very close attention to. We as your financial planners are paying close attention to it because there are strategies that may very well come out of this legislation, some of them more significant than others. So what's currently being considered in this bill? Well, one of them is increasing the top capital gains tax rate. So currently we have a three-tiered structure, and that structure is that there's a 0% capital gains rate for long-term capital gains if your income is between $0 and $40,000, and if you're married, between $0 and $80,000. That means that you could sell a stock, for example, that has a gain and not pay any capital gains tax on it. That's really pretty cool. And then most people are paying a 15% capital gains rate with, of course, with Illinois or whatever your state income tax is on top of that, possibly another 3.8% depending on your income. And then other people are paying 20% as well. So those are currently three tiers. One thing I'll just pause and say as a strategy to consider is if you have a stock that has appreciated and you have a child who has recently, let's say, graduated from school, and they might have 6 months of income this year, you might transfer some stock to them. And then they might be able to sell it in their tax bracket. They might not have to pay any capital gains tax on the sale of that stock. So I'm looking at a couple of faces on the screen for whom we've done that for your children, and that's worked out quite well. So that's a neat idea to consider. And what's also being talked about is raising this top capital gains tax rate from 20% to 25%, and also then lowering the threshold at which this would kick in. So this 400 and 450,000 number seems to be a number that is being batted around a lot in Congress right now as kind of high income earners and changing tax brackets and changing tax rates. So, kind of keep an eye on those thresholds. Another thing that's coming down the pike is some changes to the likely changes to the 401k rules. So some of you may have seen this. Peter Thiel supposedly was able, he's the founder of PayPal, and he supposedly was able to build a Roth IRA that has over $5 billion in it. Okay, this came out in June. So, let's just say that some people aren't too happy with that, with Peter Thiel's ability to put so much into a Roth IRA. And so those who are making, and there are other people too, Warren Buffett's right-hand man, hundreds of millions of dollars in Roth IRA. So one of the things that they're talking about is not allowing Roth conversions for higher income individuals. So one of the ways that higher income individuals were able to get so much money into these is that they put money into their 401ks, for example, and then they converted that, or they would put money into IRAs and convert it. Or they would take previous 401ks that they had been funding for years and years and years, and they would convert that. So one of the things that's being talked about, which I don't quite understand because the IRS gets their money right away when you do a Roth conversion. I'm not sure why they would want to do this, but this is something that they're talking about. is not allowing people with higher incomes to convert money to Roth. Some of you may be familiar with the backdoor Roth or the mega backdoor Roth strategy. And these, I'm not going to call them loopholes because they're very legal, but they have been ways for higher income individuals who wouldn't normally be able to contribute directly to a Roth IRA because they make too much income. They've been able to do what's called a backdoor Roth contribution, where they contribute to an IRA and immediately convert that to a Roth IRA. And they're talking in Congress about getting rid of that loophole so that you would not be able to do that. So those are some of the things that are being talked about right now as it relates to IRAs. And your mind probably is already turning, well, okay, if they announce that they're not going to allow Roth conversions for certain individuals, like how might I think about, like what might I think about doing about that? So we're going to get to that in the conclusion slide. And then a couple of things to mention on the estate tax. So again, going back to the Tax Cuts and Jobs Act of 2017 that went into effect in 2018, the estate exemption, in other words, the amount that you can pass to your heirs on the federal level without your heirs paying any tax, doubled, if you recall. It went from 5.5 million to 11 million. It was indexed for inflation. So right now, it's all the way up to 11.7 million. Now, if no changes are made, this is set to sunset at the end of 2025. So this is not a permanent law. But what's being talked about is lowering that substantially to $5 million. So, again, when you pass away and your estate is assessed, a lot of things get included in that assessment, including your house generally, including your life insurance generally. There are some exceptions, but for people that have large insurance policies and large real estate, it's not that difficult to get up to those numbers. And so this is really going to affect a lot of people if this change is made. There's also the last thing that I'll mention. This is kind of in the higher tier. Who this would affect: grantor trust rules. So there are some advanced strategies that financial planners like myself and our team utilize for higher net worth individuals. And these go by all sorts of acronyms like ILITs and SLATs and IDITs and GRATs and things like that. And what is being talked about is just getting rid of all of these. And so there are some significant implications to those of us who have or who have recommended to clients that they establish and fund these strategies, all which are designed to lower the amount of estate tax that your heirs pay. So these strategies take money and they put them outside of your taxable estate so that when you pass away, your estate is valued at a lower amount, and therefore less amount for your heirs to pay tax on. So this could have some significant implications if the kibosh is put on these advanced strategies. So what do you do? Well, there's a lot of things that you could do, not the least of which is if you don't like these, you can, of course, always call your congressperson and complain and see if they will lobby for you. But on a more practical level, like what might you be able to do? Well, if you're taking RMDs, the required minimum distributions, you could consider the qualified charitable distributions that we talked about. You could consider a donor advised fund. You could consider Roth conversion. And I think if they do put a cap on the limits for Roth conversion, this is a strategy that we'll be talking about a lot to our higher income clients, because this is a significant strategy that could make a real big lot of difference for you. There's also ways that you can combine these strategies. So you could convert money to a Roth and also contribute to a donor advised fund as like a way to mitigate some of that tax that you might otherwise pay on the conversion of your IRA to Roth. You could also consider realizing some capital gains. So I know like sometimes we get in this place of, well, I don't want to sell this stock or this fund because I'm going to have to realize some capital gains. But on the other side of the coin, like if capital gains rates are indeed going to go up, then it might be judicious to realize some capital gains at the end of this year. Then number 5 and number 6 relate to the last pieces that I mentioned, which is review cash value life insurance that you might have in an irrevocable life insurance trust. There might be some ways for you to refinance that life insurance, so to speak, to make it easier to comply with the future laws if they do kind of do away with the irrevocable life insurance trusts, GRATs, SLATs, etc. And then last of all, as well, why not, right? Like it might make sense for you to actually establish one of these before the end of the year. So good luck finding an estate attorney that has enough time, though, by the way, to do this, because the state attorneys are revving up to be able to know that they are going to have a limited window if these laws do pass, that they're going to be very, very busy setting these up. And we're going to be very, very busy as financial planners funding these strategies before that window closes. So with that, I would say thank you. If you're a current client, thank you for your trust, and with myself, with our team of planners. And if you're not a client and this was interesting to you and you thought, geez, my financial planner hasn't told me those things, like maybe I should give the Next Level Planning Group a call. Well, then there's my contact information. Feel free to reach out to me and I will direct you to the best place for you. I hope this was useful for you, valuable. I like to speak briskly and keep things interesting and engaging and not take up tons and tons of time if not necessary. One of my mentors, Jerry Otteson, he once said, why say blah, blah, blah when blah is enough? So I always try to consider that when I'm speaking and keep things to the point. Cassie, back over to you.
Why don't we open up the floor for some questions if people have them? Thank you, Adam, for that. I would consider very scintillating presentation. But go ahead and unmute yourself or drop your questions in the
Adam,
chat.
this is Louis Fogel. Really good presentation. I enjoyed that. Question for you about the Roth. Obviously, that's a feature of Congress, and right now it's non-taxable. But is there concern that at some point in the future the Congress would tax Roth IRAs?
Well, if you talk to an insurance salesperson, Louis, they'll probably convince you of that. But there's no situation that I can see through my lens of 21 years that an account that you've already paid tax on, right? You funded the money with after-tax money, and you let that money grow, that they would come back and they're going to say, oh, we changed our mind. Right, we changed our mind. Now, when you take money out of this, we actually we changed our mind. We are going to tax it. It's very, very difficult, even when I put my conspiracy cynical hat on, for me to see that type of policy is going to be true. I see it a lot more likely that there are other levers, and I'd be happy to talk about what are those other levers. I think there are a lot of other levers before they go after something like that. Yeah, it's hard for me to see. A lot more likely that they're going to not allow people of certain incomes to contribute to Roth. A lot more likely that they're going to not allow for conversions for higher income people. But very difficult for me to see that at some point they're just going to, oh, we didn't mean that we didn't mean that, or we take that back. My 2 cents. Thanks for the question. Great to see you.
Any other questions? All right. Well, Adam, thank you again for providing this detailed information. Reminder for all of you, our last webinar of the year is going to be on December 14th at 2 p.m. And as you may have seen in some of the past invitations, we have a mix of topics like this where it's really directly related to your finances. This next topic is more related to relationships and your relationship with yourself and others. So for those of you that have taken any sort of personality test or are interested in learning more about yourself and how you interact with other people, we're going to be having a certified speaker talk about the Enneagram. So many of you have probably heard of the Enneagram. We're going to be having Patty Breton come in, talk about the basics of the Enneagram. We're going to be sending out a link for a free test so you can get the results yourself and bring them to the presentation. So mark your calendars for December 14th at 2 p.m. for that. And also be on the lookout for next year. Adam, do you want to take a minute to talk about your plans for next year for our webinars?
Sure, I'd love to. And I would also say that, this information might have come at you pretty quickly today. We're going to be sending out the recording if you want to watch it again and digest it. Certainly happy to do that. And also, if you have any questions with anything that I talked about today, certainly reach out to your financial planner and they can help clarify or let you know. Once this becomes official, you'll certainly see it. You'll hear from us if there's any action for you to take. So one of the things that's been on my mind in the past year is how when we work with our clients, we really see our clients as the people that are right in front of us. And on occasion, what we've done is just sort of had some one-off situations where we've done some financial education for kids here and there. But what struck me is that, when we, in order for us to really serve our clients on what I believe is the highest level possible, it's important for us to educate their kids and grandkids as it relates to find money and finance. And so we are rolling out several different, for actually 5 different age groups, a financial education series that will replace this series that we did this year. So next year, we're in lieu of this, what we've done this year, we'll have a family financial education, if you will. So 5 different age groups. For example, when you get your first job in high school, like what are some things that you should think about and how do taxes work? And so, if you were used to getting $10 for mowing the lawn and now you get a $10 paycheck, but it's only $7.82, like where'd all that other money go, right? So help kids to learn about that, help them learn about the power of compounding of interest, because what we hear a lot from is, I wish I would have known that earlier. I wish if I knew today what I knew, if I knew then what I know today, how much better off would I be? And so we'd like to teach your kids and grandkids about money and about being money savvy now, so that they can have brighter financial futures.
So thank you for describing that. Really excited to roll that out over the next year. And thank you all of you that joined us today. We look forward to seeing you on future webinars and in person, hopefully soon. Thanks for being here. Take care, everyone.